NAB as stock of the day has lifted its cash earnings to $7.1 billion as a result of strong lending. Bank delivering a dividend, 78 cents, beating expectations, says it's well positioned for FY23, forecasting it will be a more challenging environment, adding that it's taken into account the changing home lending market with heightened refinancing activity and competitive pressures expected. Net profit jumping to $6.89 billion from $6.36 billion. Carl, what did you think of the result?
Oh, it was a good result, very, very solid result, pretty much in line with expectations. If they did miss, it was on the cost side and on the net interest margin. So you'll see that abbreviated in the statements as NIM. And really, I mean, this is the ultimate profitability metric for the banks. You know, it's how much they're clearing from obviously charging us a big whack on our home loans and paying us stuff all on our deposits. And the banks have had a nice little run out of that over the last 6 months, haven't they, Koshy, since the RBA got going? And of course, share prices have benefited. You know, we're up about 20% from those June lows. But I think the message here is, from management, CEO comments all the way through the numbers, is that we're kind of top of the, it's bumper profit, top of the range for a while. Best profit since 2018, so they've recovered, the poorer performance of the last few years and the pandemic. But yeah, it's all about, markets look forward, so it's all about the impact on the consumer, on the borrower, starting to come through those interest rate increases and high rates of inflation. There's a lot more competition. So the expectation is that if home loans are going to contract, you as a bank, you still want growth. So you're going to have to fight harder and harder to get that growth. And that means more pressure on margins. As I said, the cost line, I think, was a miss. And that some of that stuff's going to hang around, whereas the loan growth probably isn't. They shot the lights out on the business side of things. I think that could come under pressure as well as the economy deteriorates through 2023. So I think it's a high watermark. I don't like it on the valuation side of things. I don't like it. I don't think it's cheap. I don't like the outlook. But here's the difference. The chart is still pretty strong. So for the last 6 months, maybe a bit more, you've heard me come on the call and say, hey, this is a really interesting business. I like it. It looks cheap, but I can't buy it because the chart looks bad. This is a business I don't like. I think it's expensive, but I'm happy to hold it because the chart still looks good. But I'll monitor that as we go.
Okay. Michael?
Typically looking at the banking reports, there are sort of 5 or 6 key metrics that we look at. There's the cash earnings, the revenue, the pre-provision operating profits, net interest margins, costs, and things like capital ratios. But basically you saw that revenue numbers were strong, pre-provision operating profits were pretty good too, but where they did disappoint was on the costs and the net interest margins. So it's probably a pass, if you like, in terms of today's result. The question is looking at the outlook for the banks. Obviously they've got this shot in the arm from the big rapid increase in interest rates that's helped their margins. But as Carl touches upon, the outlook is probably a little bit questionable. Obviously there's a bit of a lagged effect between interest rates going up and the impact on the consumer and on households. And the reality is there's about 25% of fixed mortgages rolling over in the next 12 months. That will need to be refinanced at higher rates.
These fixed loan ones.
That's right.
Reverting to variable.
That's right. So there's a big chunk of the market rolling over in the next 12 months. There'll be a lot of competition to who gets those refinances. And then you've also got to be conscious of the fact that the housing market's weak. A lot of the assets that are sort of supporting these loans are declining in value. Obviously, they're pretty well protected with the LVRs that are in place. But it's going to be very difficult for credit growth to continue expanding at the rapid rate that we've become used to over the last 10, 20 years or so. So that's going to be a negative on one side of things. So from our point, we're pretty neutral on the banks. We get one side of the argument, yes, the current environment is an improvement for them on recent times, but we are conscious and cautious of the medium to longer term, next 12 months or so.
So a no or a hold?
For us, we hold CBA, even though it's very expensive, and we hold Westpac, but all the banks are roughly more or less
Westpac's report was terrible the other day. NAB's was better, but I was fascinated. There was one page on the Westpac report which is delinquencies, and that was continuing to come down and incredibly low levels, still incredibly low. Tiny amount of people 30 days and 90 days in arrears on their repayments.
And that was the same as NAB as well.
Oh, same with NAB. Okay.
Yeah.
That's
We just
interesting.
think that Westpac's got more of an alignment to New South Wales,
Right.
which was probably the first market to come under pressure.
Right.
And there's also signs that although the housing market in Sydney is continuing to come off, the rate of decline is slowing, whereas other parts of the country are just really starting to accelerate into their declines. But really, it's a much of a muchness. We're not necessarily getting new money into banks, but obviously we have a lot of clients that have legacy positions, and you've got to kind of manage those.
What I took out of it was all this hysteria about mortgage prisons and sending Australia broke and the households broke wasn't happening, with the proviso that in a couple of months all those fixed rate loans are going to revert, and that could change around March, April, May, June.
That's right, and they're still talking about probably another 1.25% of increases over the next 6 to 12 months. And
are you going Goldman Sachs?
well, that's what
4.1?
Goldman's is saying. I think what's happening is everyone's gravitating
out limbo,
higher.
aren't they?
Oh, there's NAB and CBA, I think, were at 3.85 or something.
Oh, no, CBA's 3.1.
For the
no,
term.
NAB's at 3.6.
3.6.
NAB's
Yeah,
at
they're all going
3.6,
to gravitate high. Look, the inflation figures are still very, very high. So we think that there's a good chance that it gets up there.
Okay.